Mark, you just heard what the Federal Reserve had indicated, that they are seeing some signs of tensions or concerns as a result of these trade tensions percolating through the economy, at least on an anecdotal basis. At what point does this start to show up in the hard data and really take asset prices lower?
Good question, Scarlet. I think it's going to take certainly another month or two to show real tangible data. I think Q3 earnings is when we're going to get a much firmer sense of it. And of course, the devil's in the details with regard to whether or not we see a further escalation. I think in certain pockets, such as auto and metals, as you mentioned, we're already seeing some early signs. But the broader ramifications and something that could really grip and hurt global growth is probably several months away.
You know, one thing that I find interesting, Bianco Research put out a piece saying that people are really focused on trade, but really the issue that is facing a lot of companies that we're seeing as they report earnings is the stronger dollar, and that's actually the biggest headwind to their earnings going forward. How big of a concern is that to you?
Well, I think the strong dollar has been a story, obviously, over the last couple of months, affecting EM and certainly other regions. But I think from an earnings standpoint, sure, corporate America will feel some squeeze there. But I think the other point you mentioned is actually equally important, which is labor costs and other input costs, such as fuel. You've seen the airlines starting to talk about their ability to pass through higher fuel costs. Other manufacturers, and these things don't have to do with tariffs, right? The labor cost and the fuel costs are things that were already rising heading into this period.
Which sectors of the economy, which segments of industry are best able to cope with those rising input costs, whether it's labor, whether it's oil?
Well, the sectors that have monopoly position, for example, such as utilities, they can pass through a lot of their input costs, and those that have huge barriers to competition for other reasons, for example, technology. Certainly they feel the labor squeeze, but they're not as exposed to some of these other cost pressures.
I'm wondering, talking about the economic condition in the U.S., we got these housing starts today, and the data was really disappointing. A lot of people thought perhaps this is a sign of a much bigger slowdown in the U.S. housing market than people had expected. How much are you paying attention to that, and how much is that a red flag?
I would say, Lisa, that's not on most people's radars, not most of the clients I talk to, certainly domestically and internationally. Housing is notorious for having monthly blips due to weather, due to other kind of backlog anomalies and seasonals. So I don't think there's enough of a trend that's worrisome there, but it is something to watch as rates move higher.
One thing, when Jerome Powell was testifying today among the House Financial Committee, he talked about how certain asset prices are elevated. And he noted commercial real estate. Janet Yellen also pinpointed this area. Is this sort of flashing warning signs to you?
Well, I'm glad you asked about that, because I'm sure you know if you travel anywhere in this country, whether it's LA or San Fran or Cedar Rapids or New York or Miami, there are cranes everywhere. And people are rightfully concerned that this 10-year period of relatively easy money and the turning of the tide of QE is going to catch some of these long-tailed projects off guard. And we already see it in the rental market in New York and certain other cities. So I think it is a legitimate cause of some concern looking out over 2 years.
But there seems to be a lot of talk about an impending downturn. I mean, the narrative the last couple of weeks has been about a possible recession in 2019, 2020, when the fiscal tailwinds kind of expire. How much credence do you give that?
Well, yeah, it's everybody's big bugaboo these days is predicting a 2-year forward recession. And obviously with the curve moving towards inversion, which we think is going to happen, both 2s, 10s, but especially 10s, 30s, that is a legitimate argument point. And if you have an exogenous event, such as a trade war, that could accelerate to pull forward a recession. All
right, so we've painted a fairly concerning picture here, even as the second quarter results have been coming in pretty well. How do you position for this kind of environment?
Well, it's a very tricky time because, as you mentioned, we've got this terrific fundamental story and a lot of momentum in corporate America. We've had great bank earnings, broadly speaking. Early read on corporates like J&J and a few others have been pretty benign. But it's not so much volatility on the horizon, it's uncertainty. And as the Beige book just highlighted, companies are concerned about their international activities, about currency, and about other policies that may, throw a curveball to their core businesses. So I think that positioning is tricky. We think the trade situation gets a little worse before it gets better, and so there could be a modest risk off, which could actually then help to moderate some of the policies that are pushed from Washington, and then we would see a buying opportunity heading into the latter part of the year. But the next month or two could be kind of choppy, especially given that liquidity in the markets will be thin.